This is a little myth busting. We want to do this segment regularly where we debunk some common misconceptions about ETFs. So today's story we want to talk about, investors should avoid narrowly focused ETFs, exactly like the kind of ETFs we've just been thinking about. Tom, what do you think of this idea? The New York Times ran a story on this yesterday talking about potential risks of investing in tiny little niches of the market. ETFs have now made this possible.
Well, absolutely. I mean, diversification for the average investor makes a heck of a lot of sense. However, just the subject that we're talking about right now, what about these new themes that are going to be the future 5 and 10 years ago that we can invest in now? So the argument is this: have a core portfolio, and there are a lot of core market-weighted ETFs out there for the average investor, which is great. However, take advantage of what Wall Street has to offer. And there are some themes. We've talked about cybersecurity, for example. That is not going away. Marijuana is not going away. These are certain areas that if you can do it in a diversified format, it's worth it for a small amount of your money.
Sam, you've made a whole business out of niche ETFs.
That's right.
Your entire raison d'etre, I love saying that, is based around thematic ETFs. What do you say when people say, you know, you're getting people involved in tiny little areas of the market, they might go up a little bit, then they can blow up spectacularly? What do you tell people?
I mean, our ETFs are in industries and sectors that people are looking to gain access to. We help them get rid of single stock risk. These are highly researched indexes that these are based off of, and it's a great portfolio option for people that want to invest in new tech.
So how do you tell them to invest? Do you do the usual, well, you shouldn't put more than 5%. This is my favorite line. You know, this is like play money. On your side here, you have your core portfolio, your S&P and your Russell 2000 and your NASDAQ 100. But what do you tell people?
We're not recommending portfolio allocations. We're giving them merely tools to gain access to cyber, medical marijuana, mobile payments, gaming, and then they and their advisors should really decide what is the best portfolio allocation.
For the average investor, if they just move from actively managed mutual funds with high expense ratios to core ETFs, they're going to save themselves between 1% and 2% a year. We know that.